this is a scenario now where the economy is a huge focus because we're wondering if the slowdown that we're seeing in Europe, the slowdown that we are seeing somewhat less to a degree here in the U.S., will ultimately lead to a market downturn even greater than what we've already seen. Your thoughts right now on whether or not that soft landing can be achieved both here and in Europe?
Hi, Dom. Good morning. Well, thus far, markets have been having a pretty good time in the last few weeks. And I think, obviously helped by the fact that there was very negative sentiment, very negative positioning. Markets are always driven by what's happening at the increment. And it's been a real glass half full period of two incremental positives happening at the margin. The first one is, yes, interest rates are continuing to go up. Yes, central banks are still hawkish, but the rate at which increases are taking place, that will slow down. We've surpassed the peak. It's not possible that we see, events such as a 16-fold increase in rates in the last 9 months in the US, for example. So that's an incremental positive. The other incremental positive is, again, a slowdown in the rate of increase in prices, so a slowing inflationary pressure. To your point about, well, economic data, what's happening in the real economy, especially in Europe, but also the US, those are the next two incremental factors which markets are going to be forced to look at. And those are serious risks when it comes to markets, risk assets, equities, etc.
Do you feel as though, Annika, that central banks around the world, the Fed, the ECB, BOE, others, are in tune currently to a satisfactory degree with the markets and what they're telling them, and vice versa? Are markets interpreting the Fed? Are they all on the same page right now?
Well, I think that the Fed, the other central banks as well, but probably predominantly the Fed, their number one mission, besides the mandate that they have, obviously, for pricing pressure, their number one mission is to restore credibility, to keep those long-term inflation expectations anchored. If they pivot too soon, if they try too hard to listen to cracks into the markets, they risk having a much more severe economic impact later, because they would be forced to react even more aggressively than they've done thus far. So in that sense, there is a mismatch and there is a lack of tuning in between what the Fed is having to do versus what the market is doing. But I think more importantly than that, the Fed knows exactly what it's had to do, right? Raising rates. Let's talk about the housing market. We're all alarmed by US mortgage rates of 7%. Let's not be naive. Let's not underestimate the negative wealth effect that comes from the fact that more than half of US households are homeowners. And the household sector is about 20% of the entire economy. And if a Fed official, himself is saying that home prices could go down by 15 to 20%, that's an enormous drag on the economy. And that's what I mean by the increments from an economic data perspective, from a company earnings perspective, which are clear risks.